So this video is called It All Ends Tomorrow, but they're talking about today because it came out yesterday. So it all ends today.
Start the second quarter higher. Is the US turning into an emerging market? What are the expected moves for tomorrow? Will other countries bite back? Can we survive the vibe session? Tesla deliveries on deck? And what exactly is going to happen tomorrow? We're getting down to the wire here, guys. Let's go. So we're actually seeing a little bit of a risk-on move here on the first day of trading in the second quarter of 2025, going into D-Day tomorrow. President of the United States set to announce the most sweeping and consequential tariffs any of us have ever seen. From the Rose Garden outside the White House at 4 p.m. Eastern Standard Time tomorrow afternoon, as soon as the market is closed. And so going into what's going to be one of the most important days of the year tomorrow, we've got mega cap tech catching a bit of a bid here today, with healthcare stocks being hit the hardest. And I'll show you why a bit later on in this video. But just looking at the spot here, getting a bit of an anemic bounce, really low volume. So the market's just coiling up in wait and see mode. We could really bust a move either way tomorrow, but it's starting to feel like the consensus bear case is a blanket 20% tariff across the board, while bull case is leaning more towards targeted 12 to 20% on specific sectors and countries. And there's a look at the VIX 9-day going into tomorrow, quite elevated here at 24.46. So we'll really see the move on Thursday morning. We're probably either going to get a gap up or gap down from tomorrow's close after we know what we're dealing with. But basically, if we get targeted tariffs, that's probably going to be bullish, and universal tariffs, depending on how bad they are. And then if we hear overnight other countries come out and bite back in a hard way, that's going to be bearish. But there's also the chance the market can find its feet regardless, because the uncertainty is going to be removed. And there's a look at what option dealers are pricing in for tomorrow. S&P 500 expected to move 1.6% in either direction. There's a premium of what the market typically moves. Looking back at history at similar days, NASDAQ and Russell both expected to move around 2%. So it should be quite a big day tomorrow. Definitely fundamentally speaking, and technically too, we're likely to get some moves. And I mean, the uncertainty going into this event has pretty much reached extremes. Calls for recession, stagflation, then to US exceptionalism. Now we've got some in the media comparing the United States to an emerging market. I think they're running out of ideas for fear-based headlines here and stoking fears all across the country. Also motivating an army of people that hate Elon Musk and want to burn Tesla to the ground. But anyway, more on that later. But no doubt the market is uncertain and has good reason to be. And that's because not even the White House themselves know exactly what we're going to get tomorrow. It's still being perfected down to the last minute. But as long as they're not really bad and we don't get big retaliatory action from the United States major trading partners, which is for sure a real risk, because even if we don't get it overnight tomorrow, it could come in the following 72 hours. The market's likely to remain on edge for a few days afterwards. But at least the market then will be working with known variables, can price things in better and remove uncertainties. But this will be key. What's Canada, Mexico, China, and a few others going to do back? We just heard from Canada's Prime Minister today that they're ready to retaliate. But they too are waiting to see what exactly is going to be announced. But remember, tariffs can go both ways. We've recently heard positive developments from India and Vietnam showing a willingness to cut tariffs on US goods. We also just heard Israel come out today as well and say they're removing all US import tariffs ahead of tomorrow's D-Day. And that this is to go into immediate effect, just like the tariffs being announced tomorrow from the States. They too will also go into immediate effect. We're going to start collecting straight away. But I agree with the tone of this article here. We are for sure in a vibe session. The underlying fundamental hard data is still overwhelmingly holding up consumer income and spending, along with business capex, but people are just not feeling the vibes of this economy and market. And no doubt consumers are also watching their stock portfolios come down. It's kind of a self-enforcing feedback loop when you see the bad.
Yeah, and we've talked about this before. It's called the wealth effect. And whenever you feel like whenever you open your 401k, your portfolio, your stocks, whatever, and you look in there and you see more than you thought you would, right? Imagine you open your account and you figured it'd be around 125, maybe 150,000, and you open it up, it's at like 200. You're like, whoa, honey, check this out, right? You get the phone, you're like, look at this. I done did tell you we're doing great around here. We got all this extra money in hand. We got to go we need to go buy some stuff. We got all this money. We need to go buy something today, right? And so you run up to the local Ford dealer and you're like, listen up. I need to get me an F-350. And that F-350, I want to make sure that it's the loaded, limited out, most asbestos one you got with the King Ranch and 4x4. And why don't you throw in that extra tow hitch package? Tell you what. And so you've made this offer on this pickup truck that's now probably $150,000. And you're driving home. You're like, I tell you what, honey, we doing so good, right? We look at our stocks. Everything is looking real great. No matter where you come from, right? When you look in your portfolio and you see more than you thought you had, you've got the wealth effect. You feel more rich. You feel richer. You feel better off. But the opposite is true too, right? Imagine, we're going to call this guy Sleepy Joe, or this character is now called Sleepy Joe. I done did tell you what, honey. I thought we'd be around 150 in my portfolio. And, when I went to check it the other day, it wasn't quite there. It was more like 110. And since we're down to 110, I'm gonna need to come back now. I gonna need to cut down, and we're gonna be eating hamburger helper, and we ain't gonna have none of them eating out them nice restaurants like Applebee's around here. Understand? It's a real thing, right? It's a real thing. Even though Sleepy Joe wants to be a character here, it makes it a little bit more fun to have a character, right? Sleepy Joe, when he has more money in his bank account, wants to go out and spend that. Sleepy Joe, when he has less money in his bank account, he's like, we gonna need to cut back down here, right? I ain't got that 150. I'm down to 110. So because of that, it's a real thing, right? And the signs that consumers are weathering the vibe session and keep spending. If they're feeling like they are not as wealthy, their vibes, my vibe ain't going to, I'll tell you what, them vibes, we going to be pulling back around here. Versus, oh, honey, we doing so good. Let's go to the store. Let's go get you a new Louis Vuitton purse. It'll be real good. Right? It's a real thing. So that's called the wealth effect. And a lot of people right now, because of how the market is trending down, they're not feeling so wealth effecty lately. So just want to put that out there.
Headlines in the media, then you see your portfolio go down, convinces you that it's real, it's happening. But then again, it's not all that unusual to see a really soft Q1 for the first quarter in the presidential cycle as markets recalibrate to a new administration. And as we all know, there's been quite a lot to recalibrate for this one. In fact, we just had the fourth worst month of March ever, beat down almost 6% just for the month. Good news is that typically means we bounce back in April 80% of the time. The market will find its feet and finish April higher. However, a not so good sign is when we get a soft Q1. What happens at the start of the year can often correlate with the rest of the year. And so even though we may bounce back in April, a bit better than random for bouncing back in Q2, but not much better than 50-50 for the rest of the year. And that's because the more we lose at the start of the year, the harder it is to reclaim back in the remainder of the year. So does that mean we should sell the lot and go full port into shorts? Well, I don't think so, because like I showed yesterday, even one of the greatest in the business, Stanley Druckenmiller, said after 50 years of investing, on average, he's never made money shorting stocks. And in fact, he went on later to say that he actually lost over $500 million shorting internet stocks in 1999. Even though they were massively overvalued, I've heard of many stories of fund managers suffering the same consequence because timing tops is very difficult to do. But the thing with technical signals, historical patterns, seasonality, that can be somewhat subjective. Should take it with a grain of salt. It's really just kind of a loose indication. It's like the old saying goes, if you torture data enough, it will confess. Because looking at this stat here, when the S&P 500 hits a one-year high in the prior month, but then closes down more than 5% in the subsequent month, 100% of the time, the market's higher 6, 9, and 12 months later with a pretty high average gain, more than double the average year. And so basically what this pattern shows is a market that's recently been strong, but then has a sharp pullback. And that's exactly what we've got right here. And I know a lot of you guys have been in markets for a long time, some of you much longer than myself. And so if it feels like things are moving more quickly these days, well, you're 100% correct, because that is absolutely the case. We can see that in this data here. Looking at the percentage of days when the S&P 500 moved 1% or more in each sell-off. The blue bars are corrections less than 20%. The orange bars greater than 20%. We just put in the second highest print for how fast markets are moving in a sub 20% correction. Have to go back.
Wow. So this says this is the second fastest time we've ever had a pullback of this magnitude. That is impressive. That is impressive. I didn't realize that.
Back to Q2 2010, when markets were still coming out of the GFC, getting more into the Europe debt crisis, volatility was still elevated. But looking at greater than 20% drops in the market was really only early 2020, where things were moving materially more faster than what they are now. So it's kind of crazy to think in these tariff fears, markets are moving at a pace we've rarely seen before in the last 75 years. But I don't think that's just the fundamentals of the current news flow. I think that's the structure of the market, how information is now distributed and how algos price things in, not to mention all-time high retail participation as well. Probably all adds up to faster moving markets in general. So this current correction we're in with the S&P 500 has hit 10% right in the nose. Of course, a bit more for the other indices, sectors, and hot stocks, but it's only about 30 trading days in length. Looking back in history, when we don't get a recession, the average duration of a 10% plus correction is about 60 trading days. On average, about 21 trading days per calendar month. And also keep in mind, the average intra-year drawdown for the S&P, looking back 45 years, is a bit over 14%. And so we've only done 10% at the moment. So it wouldn't be all that unusual for the market to drop another 4 or 5%. And so let's just visualize what that would look like on the S&P 500 weekly chart here. You can see the market bottomed out in October 2022. We broke out to brand new all-time highs in January last year, had a really strong year, and we've had a bit of a pullback correction in Q1 here. But as we've noted, we've only done a bit over a 10% correction thus far. And remember, on average, we can see a 14% correction. And so I think the next support zone is about a 12% correction, about 5,400. However, it is for sure possible, especially if tomorrow's announcements and retaliatory actions from other countries around the world comes in worse than feared. Who knows, we could get a sharp sell-off or maybe a bit of a grind down to potentially 5,150, which would give us about a 16% correction. So for sure, I'm not ruling that out, because like I said, it wouldn't be all that unusual looking back in history, especially in this environment we're currently in. However, the market may dip its toes below that. And unless it's a quick fake out and we get that V-shaped recovery, if we were to print a lower low and that holds, and then we take out that key level of 49.50, the S&P 500 then be in a bear market down 20% from its highs.
You know, I've heard a lot of people talking about the V-shaped recovery, and you look at this, what happened in 2024. So from July to August, V-shaped recovery. This one right here from April to May of last year. This one here from July of 2023 peaked, or I should say hit the bottom around October 2023 and came back up by December. So really 6 months of nothing right there, right? From peak to trough, back to peak. You went from July to December. These V-shaped recoveries, like people are used to. People are used to at this point. 2022 was a brutal year for a lot of people because they forgot what risk management is. 2025 is starting out brutal for a lot of people because they forgot what risk management is. And it sucks, right? But you can be in a stock that goes down for 6 months before it gets back to where you originally got back in, right? Where you originally got in, it may take 6 months for you to get back to break even. And I'm telling you, you don't have to do that. You don't have to do that. And you certainly don't need to be buying anything on the way down. In fact, I saw a comment that I wanted to point out. Dale, I find it too tempting to buy lows when the 10 is over the 20, but because of the drop, it's still below the 50. Is it suicide to jump back in? Old habits are dying hard. My dude, as long as you know where your risk is at, right? If the 10 is over the 20, but price is yet to get over the 50, like right here, maybe that wasn't the best example. Let's find a different stock. If the 10 is over the 20, but price is yet to go over the 50, right? It can absolutely be a great opportunity to get back in. In fact, right here, there we go. SMCI in October of 2024. Your 10 was over the 20, but price was yet to get over the 50. And then it went down way after that. In fact, it didn't cross back over this level, right? Let's imagine that that was where Dale got in. It didn't get back over that point from October until February. So let's say that was let's say 5 months right there. And even then, it really struggled to get over that point for a minute, and it's gone down ever since that point. So Dale, it could be a great strategy for you, my friend. It absolutely could. And it doesn't have to be 10, 20, 50. You may find moving averages that are like 5, 10, 20 work better for you, right? Better the way that you trade. But in general, this is where I learned it from, which was my friend Steve Burns. The 10 is the indicator of the short-term trend. The 20 is reversion to the mean after the upturn, after an extended trend. And a 50-day, I would put as the EMA key support level and a long-term uptrend. So if you're not getting over this key support level, it could be really difficult to get over and start a new bullish trend, right? There's no rush. There's no rush, Dale. There's absolutely no rush at all, especially when the market is telling you that it's still going down. It's still going down. And that's why a lot of people right now are getting so frustrated because their one stock, their one hope and dream. I'm not saying this is you, Dale. A lot of people out there. Their one hope and dream is on this one stock that's going to beat the market these days. But 70% of the stock's move is working against it. 70% of what's happening to that stock is working against it. And that's why a lot of people keep getting this. The monkey hammer, right? The monkey hammer, because they feel like every time the market just bounces up, oh, risk is back on, everything is good, we're going back to new all-time highs, and then it gets turned around, just like SoFi did, right? A couple times it peaked up, but it's continuing to go down, just like AMD. Every time AMD has had any sort of bullish movement, it's been smacked over and over and over and over and over. And that's because it still has not changed with its own trend, and the market has still not trended upward, right? It's dragging everything down, but you don't have to be dragged down with it. No, sir.
Otherwise, if the market can find its feet and digest this tariff saga, and we can take out and hold above 5,800, that would give us a new swing high and create for much more favorable conditions for the remainder of the year, at least consolidate. So those are the kind of the lines in the sand. 5,400 gives us about a 12% correction, wouldn't be all that surprising, and 5,150 gives us that 15, 16%. And so at each of these levels, the market will have an opportunity to find its feet and bounce. And so that's what we'll be looking for if and when we trade down to those levels. But one of the most interesting charts coming across my screen today I wanted to share with you guys was this one right here. S&P 500 excluding Nvidia versus international developed markets. So there's the SB X Nvidia here in the dark gray line. Got Japan in blue and Europe in green. Indexed to the start of this bull market back in late 22. Interesting to see both Japan and Europe quite a bit now after Q1 has outperformed S&P 500 when you take out Nvidia, which just goes to show how important Nvidia's been in this bull market. But look at that wide.
I love these kind of charts. When you take out like the Mag 7, let's talk about what this means. So the S&P 500 is a market cap weighted index, meaning if this is all the stocks in the S&P 500, right, roughly 500 stocks, give or take, there's going to be stocks like URI, Industrials, United Rentals. There's stocks like Delta Airlines and United Airlines. There's stocks like Boeing. There's stocks like Prologistics Inc., Extra Space Storage. You've got stocks like DHR, DeHanner Corp. I don't know what that is. You've got CVS. You've got AutoZone. You've got ADP. You've got PTC, right? All over the place. You've got all these different stocks that make up the market. However, the size of these blocks right here represent their market cap. And as I said before, the stock market is a market cap weighted index. So the bigger the stocks like Microsoft, Nvidia, Apple, Amazon, Google, Meta, Tesla, Eli Lilly, those big stocks, when they move, will have an outsized effect across the market. So to his point on that chart, right, if we take out just Nvidia, you can see the S&P has underperformed Japan and Europe stocks right there. That's really interesting. And then if we do this right here, oh, hang on, we're going to do a multi side by side. So there is a different index called RSP that is equal weighted versus the SPY, which is market cap weighted. So RSP. I don't want Heiken-Ashi charts. I want real charts. Thank you very much. So equal weight in the S&P 500 versus market cap weighted in the S&P 500. This goes from, let's do this low right here, August 5th. Right there. All right. So if we look on the SPY from August 5th to the peak was a 19% move. So the August 5th low to the top on February 18th, February 19th. Then we do it again from the August 5th low to the top on February 18th, 19th. Wait a minute. That actually peaked way back in November. Wait a minute. Equal weight actually peaked all the way back November 29th. It's a 13% move. Wow, that's interesting. I did not expect that result. Equal weight had peaked all the way back in November, whereas market cap weighted peaked in February. Huh, that's interesting.
Jaws gap we've got between Europe and the SP X Nvidia now. Not to mention a sharp contraction in the NASDAQ 100 valuation, its PE ratio, now sitting in the low 20s, just above its long-term average, even though growth currently is a lot better than long-term average and is expected to do so for the remainder of this year and next. And one of Nvidia's biggest customers is repeatedly hitting their limits with compute power. Sam Altman of ChatGPT actually posted on X today, if anyone has GPU capacity in 100K chunks, we can get as soon as possible, please call. And so here's the thing, sentiment can be as bad as it possibly can be. Everyone can become convinced the sky is falling, the global economy is going to get destroyed, America's turning into an emerging market, etc., etc. But at the end of the day, if the largest, most cashed up companies in the world don't feel the same way and they keep spending their money buying more GPUs, if earnings on Nvidia and others hold up and continue accelerating, it just creates better and better valuations, better and better earnings yield, while rates are likely to come down. And that presents a huge opportunity for those that can hold a stock longer than 2 minutes and weather the storm. You will earn a volatility risk premium. Even if Nvidia sold off to $50 a share, if their earnings are still expected to hold up, that short-term fear and volatility would be an awesome opportunity in my opinion. So the sentiment has to really get so bad and so persistently long that it does affect consumer and business spending and then brings down earnings estimates to kind of justify itself, like a self-fulfilling prophecy. We can all talk ourselves into a recession if we want to. Otherwise, earnings range.
Speaking of self-fulfilling prophecies, that's really how the market cycle works, right? This is the market cycle. If you're not familiar with it, it's stage one down at the bottom, which is consolidation. Stage two is the move up that everybody's looking for. This is the exciting part of trading, where you buy into a stock and it just runs, and it's the easiest way to make money of all time. Stage three is the other end, where a lot of people get really frustrated because all the moving averages are crossing over and they're not making money, but they're like, oh, it's okay. I'm just going to buy the stock and it has to go up in the future, right? It should go up. And then stage four is this side, where a lot of stocks are these days. A lot of stocks from stage four. And I want to tell you, this is not theory. This is reality. Let's look at Tesla. Tesla is a great example. That is that. Is that? Is that. This is exactly like going to the eye doctor and saying, which is better, number one or number two, right? You got like the fun binoculars on your face, right? Number one or number two. This is real. This really happens. And it is a self-fulfilling prophecy, because you're going to get more and more people screaming, buy, 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 buy. Everybody's ready and excited to buy. This is what we see in the fear and greed charts, right? If we go look at, let's just go look at the SPY right now. This is what we see in the fear and greed charts. We want to see it getting more and more and more greedy. And then the opposite's true. When people start to sell, it's a self-fulfilling prophecy as well. More and more people start to sell. It starts to move down in stage four, right? There's so much anxiety, denial, panic, capitulation, and anger going on. And it's real, right? It starts moving down. People get more and more fearful. All of this is real. And so you look at the situation and you're like, how could anybody let a 100, this is a real fact, a 100% up move evaporate? How can anybody let that happen? And it's because they went through all of these phases: anxiety, denial, panic, capitulation, anger, disbelief, that, oh my gosh, my stock doubled and I didn't get any profits out of it. There are a million people, or maybe more, who have that exact same thought as they look at the every day of their Tesla chart right here. So I'm liking this video. This is good information here, but the self-fulfilling prophecy is real.
Supreme. I think correlates more with the stock price over the long term than earnings, not sentiment. That's just short term. And just looking at the daily chart on Nvidia here, I just missed out on buying the dip yesterday at 103, got down to 103.65. But I'm still happy to take delivery of shares at 103 if we were to get there over the coming days and weeks. And as long as I think earnings and the AI boom is holding up, I would happily buy more the lower we went. I didn't use leverage for my.
Well, I did like the video. I don't like it anymore. If you are looking at Nvidia and you're saying, oh, I would love to buy it at 103. Would you really love buying it at 103 on its way down? Because I would love to buy it at 103 when it's on its way back up. I would love to buy Nvidia as it's crashing up through 103 versus crashing down through 103. Right? Nico just pointed out the SPY is down again, 1% in pre-market. The bell just rang. Yeah, and it's not looking like it's going to be a beautiful day. Happy Liberation Day to all. But let's change gears. Because I didn't like where that video was going. I am not an advocate of buying dips. In fact, that's the wrong slide. Let's go look at what the market is telling us. This is what we're looking for right here. What is the market telling us? And we can figure that out by using the master key. So it starts with the SPY signal, the buy or sell signal on the S&P 500. So let's go look at that real quick. We got a buy signal on the S&P 500 on March 27th. Now you're probably thinking, wait, the buy signal within this downtrend, and it's down again this morning. So this buy signal, whenever you see a buy signal within a downtrend, I consider that a buy to close. This is a buy to take off your shorts. If you are short, this would be the time to stop being short. So that's the way I look at it. We're also making it a little bit less fearful. If you can believe that, we peaked on the fear around 28 out of 100. So the peak on the fear was 28. So that was roughly about right there. We've actually gone up. We're down, or all the way up at 35 now. So we've gone from 28 to 35. So right around there. So if you can believe it, we're getting less fearful in the market these days. Interesting to note, right? And in fact, all of the 500 stocks that make up the S&P 500 on average are actually getting less fearful as well. That's what this chart is representing right here. So We got a buy signal here, but we know the market trend. We apply the outlier trend template. The 10 is under the 20, price is under the 50. We know hands down for sure, without a doubt, that this is a bearish trend. It does have a couple order blocks down here, which has provided some support. Tell me order blocks don't work. Tell me order blocks don't work. We've had two bounces right there. So we've got a bearish trend, a bullish signal, and then let's go look at market breadth. So market breadth measures how many stocks are on our. Yes, Josh, I do that as a fun joke. Thank you for noticing. The market breadth measures how many stocks we have on the bull list with buy signals versus the bear list with sell signals. Today we got 34 new buy signals versus 46 new sell signals. Buy signals today including Atmos Energy, First Energy, General Mills, and Noble. I don't know what Noble is, but that's what it is. And then on the sell signals here, we've got CDE, we've got IART, which is Integra Life Sciences. We've got sell signals on iTube, Unibanco, and then we've got Kinder Morgan Inc. All of those have sell signals. So the market breadth is measuring how many buy and sell signals we have. So on the bull list today, how many buy signals we have? 34 new sell signals. However, you can see over here that the market breadth has peaked and we're getting more and more sell signals versus more and more buy signals. Then we can throw a moving average on that and we can see it's actually crossed down. So we have a bearish market breadth right now. So we've got a bullish signal, bearish trend, bearish market breadth. And then we can take a look at one or two of the sectors real quick. If you click on the sectors up here, you can see the white, the red, and the blue. I'm sorry, I should say blue, green, and red. That's the overlays. So what is an overlay? Let me show you what I mean. If we go to eBay right here, this would have passed my screener criteria today. The overlays are the backgrounds right here. This one doesn't have any red overlays in eBay, but this is showing you right here if they are within an uptrend or downtrend. So for example, Staples is actually in somewhat of an uptrend, and you can see it right here. The Staples sector, which is a defensive sector, actually has greater growing market breadth, whereas the tech sector has shrinking market breadth. You can see right here that has really collapsed right there, the number of buy signals versus sell signals here. So for me, we've got a big mixed bag on the sector breadth, but this would lock me out of the market, right? I want to see the market all in alignment. When it's all in alignment, it just makes life so much easier. But real quick, my name is Christopher Ewell. I've twice been awarded top 100 people in finance. I was mentored by 5 of the market wizards, the best traders of all time. I've been successfully trading since 2009, and this is where outliers like us save time, make money, and start winning with less risk together as a team. So go ahead and subscribe if you haven't already. And let's start looking at some of your stocks. What are you looking at these days? That's what I want to know. So put your stocks in the chat. Be sure you put in something like Monsanto long. Be sure you put in the ticker symbol so it's easier for me to find. Nvidia short. You could do Apple long. You could do Tesla short, whatever. I want to know what you are looking at, and then we'll rank these stocks from a strong sell to a strong buy. But I'm telling you right now, nothing's going to get a strong buy. The best it could get is a weak buy because the master key right now has everything locked out. Everything is locked out. But while you're doing that, let's go look at the screener picks that pulled through for me today. So I mentioned this on yesterday's live stream that somebody asked me, hey, Chris, where would your stocks rank on here? So first off, my stocks, I would never, and this is my opinion, I would never put on a stock that didn't meet all of my criteria. If it does not meet if 100% of my criteria, if it's even 1% off of my criteria, I would not trade it. Why? Because there's no reason to put on risk in anything that you can't tell right there has a perfectly set up plan for the way that you trade. Not the way that I trade, but the way that you trade. So for me, these are my scanner criteria here. Positive outlier return, greater than 1 million shares average daily volume with a buy signal. Price change less than 5% in the last 5 days because I want to get in before the outlier move happens. All market caps greater than $20 because I'm a snob. Fear and greed, basically everything up to a greed value of 90. I want to see the heat map. So the behavioral heat map down here, if it's moving up, if I'm buying it, and then the uptrend indicator. That's the 10, 20, 50 we talk about right there plotted on the chart. So first one is eBay. Let's go take a look at eBay real quick. We can zoom in. We can see it's within its uptrend. So 10, 20, 50 all crossed up. It's got a buy signal. It's getting more greedy, less fearful. This is around 46 right now. So it's really right in the neutral range, right in the neutral range right there, but getting less fearful. But the sector itself is getting a little bit more fearful in the discretionary sector. And if I go over to here, eBay, are there any order blocks in the way? No. So this one, for me, would be a weak buy. And the reason it'd be a weak buy and not a strong buy is because the master key has it locked up. But I wouldn't take it because the master key has me locked out. Let's look at one more on the screener. PPL. I don't know what PPL is. PPL is headquartered in Allentown, Pennsylvania. PPL Corporation is the largest company in the U.S. utility sector. Oh, I didn't know that. PPL's 7 high-performing award-winning utilities. Okay, so they're utility stock. And let's see if there's any news on PPL. Neutral, neutral, positive, negative, neutral. Nothing really going on over there. Any analyst changes? All the way back in December, we got to outperform overweight. So a hold to buy. Overweight, that's not what you see on the scale. Overweight means they're going to hold a larger position of that. So this one here, looking at a buy signal. We're looking at a green overlay. We've got our 10, 20, 50 all crossed up. We're looking at the fear and greed heat map growing. It's at 62, which would put it right here, a little bit into the greed category on 62. And then the utility sector also is looking a bit greedy. We can also see the market breadth down here. Now, I know it's difficult to see. I did ask Mahesh if we could have some changes on this. So there are a bunch of changes that we are working on right now in Outlier to make this easier for you to use. One of those changes I want to see down here. I love being able to see the market breadth, so I don't have to go into the market breadth tab to see that, but the colors on here do make it a bit hard to read, but it does show a crossover bullish on market breadth. And then let's go look at PPL over here. Yeah, no order blocks in the way. PPL, again, this is what I'm talking about. If it comes through my screener criteria, that means it is perfectly set up for me. However, because the master key is locked up, I'm not buying anything. Not buying anything these days. Let's look at Hopecast. Let's look at Orly Long. Let's go look at Orly Long. So close a few tabs here. ORLY. Oh, very cool. All right. So let's look at all the good stuff we see here. We got a buy signal. It's getting more greedy. That's what we want to see. The sector, however, getting a little bit less greedy, a little bit more fearful. And then if we look on the sector breadth, let me get out of the way here. So this shows our sector breadth. The green line is the absolute value of that. The 10 EMA shows up blue. It's still bullish on the sector breadth. We don't quite have that crossover yet. And I know that's a bit difficult to see, but this actually lines up really well for me. The only negative here is the sector is getting a little bit less greedy, but otherwise it looks really good. We look over on the chart on Orly. Yeah, this looks great. This is a beautiful stock to me. That's a beautiful, the best case scenario for me. That's a weak buy. I like it. I like this one a lot. I got that 5. There we go. Yeah, it's the same value as this. It's just handy to have it all in one place, but not quite cross down on market breadth just yet. So this is actually looking pretty good to me. Let's look on the chart real quick for any order blocks. No, this is great. This is the best. This is a best case scenario for me. So this is a weak buy for me. I like it. Architect Ray, that's a really good one. Okay, lots of ones. Very cool. I appreciate that. I tell you all this every day, and it's very true. I really try and make these free YouTube videos better than most people's paid courses. And so that means that you guys are learning as we go all the different things that I would look for whenever I'm trading a stock, right? And because of that, it's going to set you up for success. And right now, holding cash is the trade. I know it sounds crazy. I know it sounds, I saw that, Joshua. I know it sounds crazy to say holding cash is the trade, but holding cash is a risk-free trade. And in a market like this, where we don't know what's going to happen with tariffs, right? We're already back up by 66 basis points today. We may even close green on the SPY. This may be the absolute last downtrend day, and then we go up from here. I don't know. Nobody knows. We can only trade with what we see on the charts today. And by knowing what we see on the charts today, it makes life a lot easier, right? So be sure to come back this afternoon where outliers like us will save time, make money, and start winning with less risk together as a team. Now, YouTube is going to pop up a couple recommended videos. I recommend you watch one of them. I also recommend you come back later on today. We'll talk soon.